Did you just go harmonics on that?
I did. How's that?
That was pretty outstanding.
Take it.
Guys,
Take it.
it
Thank you.
it it is MLK Day today. Happy MLK Day, Mr. Babcock.
Happy MLK Day.
Guys, Monday, 5 o'clock. It's time for After Hours Real Estate. I am Chris Pesek, broker associate of the Dripping Springs home team at Pesek Properties. Longest name ever. This is my buddy, Stephen Babcock, mortgage lender extraordinaire at CMG Financial. And I don't have our banners, our branding up here, man. I'm sorry.
Yeah, that's all right.
That's here we go. How about that? Oh, that works better.
Love it. Oh, I
Adjust
can
it.
take off that out of my name now, can't I? That's good. I won't use that next time. That's good.
Wait, what?
The NMLS.
Oh yeah, you can take that off because I've got you taken care of. Guys, we show up here on Mondays. We drink a little bit of adult beverage. And we talk about the world of real estate, the world of lending, the world just in general. Oh, my man has got Lone Star strawberry. I like it.
Just Lone Star.
Yeah, red tops. We call them strawberry sodas.
Oh, I was gonna say I'd never heard of a strawberry Lone Star. Are you drinking water?
Cheers.
Dry January?
I'm drinking water with some lemon and some ice and vodka. I mean, it's so hot today, man. This is like spring drink, summertime drink for me.
Chris,
What's up?
I'm disappointed in you.
Really? You didn't think I was a vodka guy?
Oh, is it vodka? I didn't hear vodka.
Oh yeah, no. That was the last thing I said, and that was on purpose. Like I drug it out before
Thanks.
I told you that there was vodka.
After hours real estate, not hydration real estate.
No, sir. There is good night loving vodka made right here about a half mile from my house in Dripping Springs, Texas. Just saying.
I met this new agent today, and he's an adult. He's a real estate agent. And we get to a coffee place. It's late in the afternoon. I'm like, hey, if you want to grab a beer, I'm okay with the beer too. And he was like, dude, I'm 19. I'm like, oh my God, I just offered alcohol to a minor, right? Like, I didn't even know. I had no idea. Glad he told me. Yeah, could have been worse. Could have been a lot worse.
Hey, you know what? If you bought him a beer, you might get his business.
Yeah, no kidding. How about a case of wheat, kid? No. Right. It turns out he wasn't a really big drinker, and he's calling like 100 people a day.
Good Lord.
Yeah, he'll do fine.
Good for him. Good for him.
Fine. Even in this market, he'll do fine. I promise.
Yep.
Yeah, that many phone calls, you'll be fine.
Oh, by the way, guys, if you're still drinking Tito's vodka, stop. Start drinking good vodka.
Tito's was never good.
That's what I'm saying. Stop drinking Tito's. It was never good. Start drinking
but it was
good
free
vodka
for a long time. Do you remember that app? God, there was some app. Doesn't matter because I can't remember what it is, but open something or go out for the night or something like that, and you could go to a bar, open up the app, and it would give you a discount on certain drinks. And one of them was always Tito's vodka. You could get the first shot for free, and then the next one was like $1 for every shot or something. I remember spending like $12 and getting like 14 drinks between me and my wife with that app, which has gone out of business ever since. They ran out of funding.
Imagine that.
Why? I don't know why.
Yeah, I can't imagine why.
Yeah, it's so weird.
Well, man, anyway. let's get into some real estate here. I'm hearing mixed reviews. You and I were chatting right beforehand, and you were saying there's some people freaking out. And I'm starting to talk to some mortgage people who are saying their phones are starting to ring quite a bit again.
So I myself are getting a few leads here and there. But what I'm not getting are people that are committing. I'm getting a lot of people looking.
They're curious as to what's going to happen this year.
Right. Or they see the prices and they say, okay, well, I'll stay with renting.
Yeah.
Right. The problem with that is that rents are delayed by about 1 year.
Oh yeah.
So if the homes cost way too much this year, the rents will cost way too much next year.
Yeah.
And so, hey, that'll help now. Maybe next year the homes will be less, right? So who knows? But I'm seeing a lot more, but at the same time, not a lot more interest. So not interest. It's the wrong word.
Commitment.
I don't need to
not as much commitment.
Yeah. Nobody's really pulling the trigger from what I'm seeing.
Okay. Interesting. Yeah. I haven't I'll tell you again, anecdotally, with my listings, generally, and I tell every one of my sellers this, guys, the period between Christmas and Valentine's Day is dead for listings. It's dead. Historically, it is dead. This year, I'm actually getting fairly consistent showings. I'm
Good.
a little bit shocked. That is a good thing. I'm starting to get some more calls. People, they're considering putting their houses on the market. I've got a couple that I'll be bringing to market this year, that I actually three that I know for sure. People are like, it's time to sell. Okay, good. So all of that is cautiously going. I know there's still a lot of stuff that could put the damper on this, but it's cautiously telling me maybe I was right, that this is kind of going back to, let's call it a typical market from 2014, 2015. Okay, maybe.
Yeah,
Rates are
it's
higher. Rates are higher, but
what I get is when people come to me and all of that wind leaves their sails. Not to
once
say that
they
I'm
talk to
Debbie
you, once
Downer
they
or
see what
anything.
that payment is,
Maybe it's my fault, right?
then
Yeah,
that
no, but
stops it.
let's think of
Hey,
it
you need
this
to be
way.
a better salesman, buddy. Come on.
Well, I'm on a mortgage calculator right now,
Yeah.
and it showed up with a 240 loan amount. I'm going to keep it there.
Okay.
And it showed up with a 7-point-something% interest rate. We're just going to call it 7%. Okay. So 7%, 240 loan amount. I'm paying $1,597. Let's just call that $1,600. We're $3 off. Let's call it $1,600. That's easy math, right?
Yep.
If I did a 3%, which is what most people were refinancing for, it's right around average,
Yeah.
right? It's $1,012. Let's just call that $1,000, right? $12 off. We're talking roughly $600 difference for the
60%
same
increase.
house that last year was the same house too. So
And that's it. Wait, now what was the first rate you did?
3 and then
And
7.
okay, 3 and 7. Okay.
So on a 240 loan amount, that's going to be a $600 difference roughly. Now let's take a realistic number, like $400,000 for the loan amount, right?
It's still going to be about 60%.
Well, sure.
So
3%
180.
is 1,686. Let's call it 1,690,
Okay.
right?
Call it
And 7 is
1,700.
2,661.
Yeah, $900. And there's your 40 or 60%. Yeah.
So, hey, it's time to go. Hey, babe, let's do it. Let's get the bigger house. Hey, we'll just go talk to our mortgage lender. And then you come back and you're like, babe, I got some news.
Yeah. Yeah.
It's going to cost us a lot more than it was before, right? And most people are saying, we'll just stay where we are right now,
Yeah.
or we'll find a rent that's cheaper. And
Yeah, and that goes back to what we were talking about last week, where it's the moving out of need, not the moving out of want. Well, some people are moving out of want because downsizers and stuff like that would still potentially move out of want versus need. But at the same time, if you're in a house that's costing you $500 a month to heat and cool, and you're paying $500 a month or $400 a month in HOA fees and all this other stuff, and you want a little piece of heaven on a little small piece of property, okay, who cares?
Yeah.
So there's, again, it's a need versus one thing, and that's fine.
Yeah, I think what really happened was the low rates caused a larger demand. And now that we have higher rates, they're causing a lower demand.
Yep.
But it was almost an artificially high demand at those low rates.
It was. The government was we'll call it subsidizing home purchases.
So, you had a lot of people that were buying that probably wouldn't have bought if the rates were higher.
No, absolutely wouldn't have.
And now that they are higher, you have a lower buying pool. I mean, the Wall Street Journal the other day, I think it was saying that with the rates where they are, the available buyer pool has dropped by 40%.
The article I sent you, 18 million people have been forced out of potential buying.
Okay, but what that doesn't say is the other 60% that, or whatever it is, that looks at the new price I show them and says, we're not doing that.
Right. That's just the people who can't buy, not the ones who are like, hell no, I'm not buying now.
Right. Can't and won't are two different things.
That's right. Need versus
want.
want.
You got 40% that now can't, and then okay, fine. What are we left with? 60% now. Okay, great. So here the other 60% now is looking at the price saying, do we really need to make this move? Yep. Right. And so that's what I'm seeing. So yeah, I'm seeing an uptick. I'm hearing an uptick in lowball offers. Yeah, we got
absolutely.
$100,000 under asking prices today, or offers today, right? So yeah, we got multiple offers, but multiple lowball offers.
Yeah.
And
by the way, guys, if you're wanting to go out and find an investment property and make lowball offers, I'll make them all day long.
Right now. It's right now. Yeah.
Because here's the thing, it just goes back to right now. It's a necessity market. Either you need to buy or you need to sell. So if somebody needs to sell, it's just a matter of finding that bottom number. And if it works for you as an investor and it works for them as a seller, let's go make a deal.
Yeah.
I mean, it's that simple. It is a need market. They need to sell if they're on the market right now. and that's why investors are doing it. I don't blame them a bit.
No, I don't. I don't either. But it is what it is. So it's
Yeah.
a tough market right now. If you're a seller, if you're a
Oh,
buyer,
100%.
if you're a buyer, you're good to go. Especially if you're a cash buyer. My God.
Oh God.
And the rates historically they're fine. We're good. We're on average right now.
Yeah,
Um,
it's nothing different.
I have been saying for months though that we're under the historical average. Now we're at the
At,
historical average.
yeah.
Um, maybe a tiny bit above it. And so, who knows? It does look though like rates are going to get better. The
Okay.
Fed keeps raising rates, but the mortgage rates keep going down. And again, when the Fed raises rates, that's basically makes it more expensive for banks to borrow money from other banks.
Yeah.
There you go. But
if they have their own money to lend,
then they don't care.
So that's an interesting point you bring up, and I want to dive down this hole. Okay, so and if I misspeak here, please stop me. But let's say you've got banks, you've got Wells Fargo, you've got Chase, you've got the ones, those are the major lenders. Okay, and now it gets more expensive, and they have their own money to lend, but it also gets more expensive for them to borrow government money. But then you also have, we'll call it City X Bank, who their money is in house. It's a lot of farmers and ranchers have their money there, and that's the stuff that they're lending out. So they have their own money. So their rates have gone up a little bit. No, Aaron, I am not in the CO. I got back last night about 2 a.m. But their money is not costing them necessarily more. It is because CDs have gone up and things like that, and checking account rates have gone up incrementally, but they've gone from like 0.9 to 1.9.
What is that?
What do you mean?
What is it? Why'd it go up?
Because everybody else has gone up, and that's where I'm getting to my point. So they're given. Oh no, okay.
Mm-hmm.
So I'm misspeaking.
Because everybody else is doing it. You don't want to have a higher rate. You want to be the lowest rate around. Everyone goes to you.
You're giving a higher rate in order to get more money that you can lend out at a higher rate.
Why not be the highest rate? Same question, but in reverse.
Yeah.
Right. And in fact, I see a lot of this stuff advertised with these banks making record profits, but that's not accurate.
No.
If the bank can borrow at 2% and they're offering 4%, they're making a 2% profit,
margin,
right?
Yep.
If the banks can borrow at 5% and they're selling you a 7% loan, they're still making a 2% profit. And man, it's not because they just want to, right? Now you get other big banks, and this is where it gets really interesting. You get other big banks that are making like let's say like Guild Mortgage, for instance, which is not my bank, so maybe I should stop talking, but they're great. They have been saving all of their loan, well, not all, but a lot of their loans since the 60s, meaning they send out the mortgage statement. That person pays them every month the mortgage. Well, you get
they're not selling them on the secondary market. Yeah.
Right. You're keeping it. So they get a servicing fee when they do this. Well, times, 60 years of mortgages, et cetera, 70 years, right? All of a sudden now, they have a lot of people paying them every month for servicing these mortgages, right? Well, then they can turn around and lend that money out at any rate they want to.
That's right.
Right. Well, then what about Wells Fargo? They're making a lot of money because otherwise they have to go borrow the money.
Right.
Right. Which is now at the Fed funds rate. Okay. And then they can then use that money to lend it out. But when people say the Fed's fund rate is not mortgages, you've just heard two examples of how it is and totally isn't at the same time. So it gets very, very confusing very quickly. But if you can generate your own money as a bank, you can lend it for whatever you want. Yeah. Right. So what we're actually getting right now is a culling of the industry, kind of like Rockefeller and his oil, right? Where he priced it below what everybody else could do it for. And then when everybody was out of business, he then raised the prices, right? Well, if you're a bank and you can offer a 4% interest rate when everybody else is doing 7%, you win and they lose. And eventually they go out of business, and then you can raise your rates.
And so that's what I was getting at. And I'm going to pop. Aaron has got a long comment here that I'm going to pop up. We're going to go through and dive into that. But that's what I was getting at. So the smaller banks that the market is kind of setting this high rate. Well, they can max out and get that bigger margin, whether it's 3 or 4 or 5% compared to where they got the money in. But at some point they can drop down below everybody else and force the other people out of market. And you just nailed it. I mean, that's exactly where I was going. So, if to me, if I'm going to buy a house right now, or not necessarily a house, but let's say an investment property, I'm going to go find me a portfolio bank, small bank, again, City X,
You
LLC bank.
do it to a credit union right now.
Yep, credit union.
So
There,
even Jamie Dimon. In fact, Aaron put a comment down. Can you put that
yeah,
up?
I'm going to pop it
Like,
up. He got burned last time. All this crap happened. The new variable is inflation. You're right. Vegas, where Aaron lived before, had a double dip. Banks are going to tighten with higher rates, and that's the breaking point where banks have to take on the risk to make money if people are not getting loans.
So Aaron, I don't know what you know, so I'm just going to talk. The banks are part of a system called fractional banking, and what that means is when you deposit money, they are
Time out for a
required.
second.
Yes,
I'm going to let you know, and I want you to go on with this definition. Aaron is an accountant.
great. He knows. All right, fine. Great. Um, Basically, it requires for everybody else watching. It requires that if I deposited $100 in the bank, it requires them to keep 10 of it. But they are then free to lend the other $90 to somebody else. So if I immediately wanted my money back the next day, let's say, they might not actually have it there. They may have to wait to get it back, right? So it was a really good question that you had, especially what is the breaking point where banks have to take on the risk to make money. They have taken on the perception is that they're not taking on risk right now and that they're playing it safe and that the Fed is the real issue. The real issue is there's too much liquidity out there. They have given way too much money away. And a small recession will cause many of them to fail, but they're expecting a big recession. Even Jamie Dimon, CEO of Chase Manhattan Bank, was secretly recorded, and I'm sure if you're an accountant, you've read this right in your news or whatnot, but was secretly recorded, which was then, of course, leaked, saying that this year we are going to expect an economic hurricane. And he basically stated that it wasn't going to hit until the end of December and early January until you'd really start seeing layoffs and this really hit. So who knows? But man, if people aren't getting loans and the banks are going out of business, some would say that's a tragedy. Others would say that's a wonderful opportunity. And those others have been posting about it for years now, about how you will own nothing and be happy about it. And they've publicly stated that they want a large crash so that people then have to, come save me, help me. And then they'll do a digital currency. And our own Fed has been testing the CBDC, which is a central bank digital currency. And that's the plan. It's the stated plan. It's not a fringe out there. I mean, it would have been 10 years ago, a fringe out there kind of.
Yeah, but at this point, it's out in public.
No, and there's many world leaders that attend these things every year, and there's the mission statement. Go to the webpage. There's no, they're not lying or hiding it, or it's flat out there. So if you don't believe, you just haven't seen it. Period. Right. I'll tell you, it blew my mind when you actually get older and look up this stuff instead of just listen to your neighbor or your friend and be, yeah, that's what happened, right? You should look it up and you read the mission statements that these companies come up with, and it's like, am I getting angry about this? Right? Like it's unreal. But yeah, I don't know. I think you're about to see an economic hurricane. And I don't want to be a pessimist. I'd love to be an optimist about this, but
I'm an
maybe
optimist.
they're wrong.
That's fine.
Maybe he's wrong.
This is yin and yang.
Yeah, and then there's Michael Burry, who's been calling it for 2 years.
Yeah, 2 years.
He always calls everything, and then 2 or 3 years later, it happens. He says he's always right, but wrong on the timing, right? And that's fine.
Well, that's more people than not. I mean, calling timing is impossible. Again, you always say if you could call timing, you'd be spending all day on E-Trade, whatever.
Right, be on E-Trade all day.
Yeah. I mean, and that's what everybody would. If anybody had any idea about timing, all they would have to do is sit on E-Trade, on a beach in front of their $100 million, Italian villa, whatever.
Yeah, be at the top of a mountain and get on my skis, but
yeah, exactly. Whatever. Well, yeah, for me too, but whatever. So, all of that, that you're diving into, the question that I keep going back to is, okay, the head of CEO or the head of Chase can say that, but we all saw what happened in 07, 08, and the banks have no concern. So that's what my thing is with Aaron's question. When do the banks have to take on risk to make money? to me, they can take all the risks they want because the large banks are not going out of business. The government's already set the precedent that they're just going to bail them out anyway. The
That's
only
very
people that are
correct.
going to go out of business are, again, City X LLC Bank down here in Anytown, USA. Those are the ones that are concerned.
Look, I understand the perception is that we bailed out the banks, and quite frankly, we did. But it wasn't just the banks. You and I have discussed this. If you show up and you're an AT&T employee and you show up on Friday and your paycheck just never arrived, you'd call HR. Hey, there's a problem. Well, HR is on the phone with Chase Manhattan Bank, and they're being told the funds are coming, just wait, and they never show up, right? It wasn't just the banks that got bailed out, and they did.
Oh, no, not a, yeah.
Bear Stearns, brother, you took too much risk and you went out of business. So I get it. I'm not an idiot. I was alive then. I went through this. I know that, you know what I mean? Like, I'm not trying to say that there wasn't a big bailout for the banks. There was. Yeah. But that's the talking point. That's the simple thing to say. It was way more complex than that. Yeah. And the banks were desperate. They were begging. I mean, begging. If you don't do this, we are done, kind of thing. And by the way, they were right. Now, it was their fault. It was totally their fault. They got us into the situation. So again, don't think I don't know, right? But I'm not talking to you. but in general. But it just wasn't such a simple of a solution. Here we go.
Well, I mean, the solution is simple. It's either don't bail them out, shit hits the fan, and survival of the fittest. That's Darwinism at the economic level, or bail them out and kick the can down the road, and that's what we've done. So it's to me, it is a black and white. It's a simple call, but they made a call, and this is where we are as a result of it. So whatever. I'm not going to say it was the right or the wrong call.
That's a good one.
What's that?
So put this new comment up. This is a good one.
Oh, I missed it. Firm believer, economic indicators are always 6 months to a year. Yep.
Correct.
However, they don't account for the severity of the dissections. We know that rich people are liquid. We know that retirees are liquid. Yep. I'm liquid in the grave. Yep. Or is it the people who are average Joes don't have to give their firstborn for a house? Dude, you got to go on that.
Well, I'll let you know that we are giving a $50,000 bonus for all firstborns.
Yes.
So if you do want a house, come to me. We'll take care. No, that's not true. I feel like maybe in this day and age, I have to say it's not true. I'm totally messing around. Okay, so I get what you're saying. I specialize in first-time home buyers, and I haven't helped one in like a year. So, damn it. Yeah. Just capital D. Damn it, right? What's funny about the rich people being liquid is that right now, something like 60 or 70% of people are living paycheck to paycheck, and 50% of that number are people in the six-figure range. So you've got a lot of rich people that are really suffering right now. Not to say a rich person is suffering is probably an oxymoron, right? So whatever, fine. But not well. Not,
but again, I mean, you got to define rich as well. I mean, in this day and age, and this kind of goes to Aaron's point, 6 figures will maybe buy you a house in Dripping Springs as a household income. Maybe
Dripping Springs has become a luxury market all of a sudden.
But again, my point is, okay, so is what is rich? That's my point.
Hey, so I do loans for people all over Texas. And if you're in Houston right now, I have done pre-approvals for people there that are buying at $250. There's one woman I have right now who's qualified at $150, and she is buying a home in Texas. So, she's not in Austin. Okay. But, we also don't live, in 90210, right, in Beverly Hills or something like that either. Right. So at a certain degree, there's plenty of homes that people can buy. If without selling their firstborn or whatnot, right? And trust me, I get what you're saying. Now, if you're in the Austin area, there's nothing right now. Now it's quickly dropping. There was a friend. I don't know if I told you this or
areas are quickly dropping.
Oh, brother, there was one woman I was talking to. She showed me the email. I was talking to her yesterday. About 4 or 5 months ago, Open Door was saying they buy her home for $600 and change. And now they're saying it's like 411,000, right? And so, I mean,
but look, time out. Let's not say that Open Door is the market.
No, however, if I'm buying through Open Door, it's the market, right? The market is whatever someone is willing to pay, right?
Well, that's fair. Okay.
You just took a haircut of 1/3 off the price of that house, right? And so, give me a little bit more of this economy, and chances are we could do another 1/3 price cut. And now we've got a whole new issue of people not being upside down. I mean, on the home, not being able to afford to sell. in a time when the rates are even higher. And that's really, I think, what most economists are truly, truly worried about. So, Aaron, what you're saying, though, means that everybody else that buys around you has to pay the same price you did. So if you are an upstanding person that makes, $200,000 a year and you can't buy a house, well, the home that you buy, all the other people living there are $200,000 earners too, right? Eventually, these things work their way out. You get a supply and demand curve, and it's specifically when the government gets involved, but other factors too, but especially when they do, and throw an incentive in, it artificially creates demand, right? Which then pushes prices out of whack. I saw this. I've seen it plenty of times in my career.
East Austin is a perfect example of this.
Yeah, and so give it a couple years, the prices will come down, and then equilibrium, and then people will be like, "Oh my God, it's an up market again." And we'll be talking about how it's time to move in now because it'll be worth more later. Well, I think your home is going to be worth less money next year than it is right now. I do, but there were times on the show that I thought it was going to be worth a lot more the next year, right?
You and I are still disagreeing on that. I'm just going to go on the record.
Hey, you know what?
That.
Great, and we disagreed 6 months ago too. Not to rub it in your face, but at the end of the day here, it doesn't matter if I were right all the time, I'd be in E-Trade all day, right? So I'm not right all the time. I'm not trying to be a jerk about it, but let me see here. I love this. By the way, Aaron, thank you for commenting. I love your comments.
Well, that's the thing. He said a while ago that he doesn't want to derail the show. Dude, you're not derailing the show. You're getting the stuff talked about, and this is like real stuff. Because you were in Vegas on the double dip, and you were 300, then you're 200. Okay. You took a 1/3 haircut, and
But I don't think you can give me a single example of someone that was upside down in 2008 that last year was not upside down.
Wait, say that again?
Granted, we're in a down cycle right now, so I don't want to use today as an example. But you give me somebody who was upside down on their mortgage in like 2009, let's say, right after the last crash, right? Take me back 1 year from today. I think they were probably not upside down anymore. I don't think there's even one example of someone that was still upside down from that.
But even today, they're not upside down on a mortgage they had in 2009.
That's my point, though, is that Aaron may have gone from 295 down to 200, but if you wait long enough, history says
bring it
back in the green again or in the black again, right? So
you just have to hope and pray at that point that you don't have to sell. It's not you don't have a need.
Right. No, that's a whole other discussion. But the investors.
But again, going back to need versus want. Yeah.
What's my rate of return? Right. Yeah. So do I sell it? Do I rent it? There's so many different things you can do with a home afterwards, after owning it. So you just go through the list.
Okay, and so I got a question from a watcher offline. There
nice.
You go.
Good.
Now yours broke even.
You didn't lose money, right?
You didn't lose your ass. Now technically, I guess you lost $100,000, but you
depends. Did he rent it out? Right? Did you rent it out the whole time, or was it just you? If you rented it out and broke even, then all of a sudden you got those years of making money, and there's ways of getting around it. Let's put it that way.
Perspective, right? Perspective.
Wow.
So anyway, I got a text from a client we've talked about him before, but anyway, the question was going back to your fractional lending and that banks are required and stuff like that. So let's take a hypothetical bank and let's call it GMC Mortgage. Okay, and let's say that they're
let's do ABC Mortgage. How's that sound?
ABC Mortgage. See, there you go. Lived rent free.
That's the best.
That's the way
trying to get a mortgage, then that's not okay. But yeah,
that's the way you got to look at it. So, and there's unique products out there that are trending, products that you and I both like. So, do those banks are they allowed to lend that money that enables a client to get that product, or does that stay in house?
What are you asking me?
So, let's say that a client has to have a certain. Client has to have money with a bank to get a certain type of mortgage. Okay, you want me to spell it out for you?
No. Okay. I think you're talking about a doing a mortgage because you happen to be a member of the bank, right? So
no, not at all. So I've got I'm gonna put my money in a bank and they're gonna make automatic withdrawals, and that's gonna help me pay my mortgage down.
Chris, come on with it. What are you saying?
Okay, so all-in-one loans. The money that's with a bank that does an all-in-one type product. Does the bank take that money from that person and lend it out on other products?
Now that is a really good question. That is a really good question. I don't actually know the rules associated with a private bank like that with a
Right.
what's the word I'm looking for? Credit union. I don't actually know the rules, so I don't want to tell you, but I will guess. I'm happy to guess. Um,
I've got a guess on it too. I'm going to let you go first.
I would guess that they have the option to save as much as they want, of course, but that they have to answer to a board of directors, which is probably a group of the owners, which would say what is acceptable or not acceptable at that
Yep.
bank. When you've got a bigger bank, you're federally government controls you. But when
Right.
you are a credit, I can never remember the name. When you're a credit union, you're controlled by the depositors of the bank, from what I
Hmm.
understand. So it would they could say let's have a different standard. But I do believe, and again, I don't know this. I this came with a disclaimer, right? I don't know the
Right.
answer, but I do believe that every credit union would be different than as a result of those members of the bank coming up with different policies, etc.
Got you. And let me make sure that I got that question right. So, but the bank has the ability to lend that money out if the board members choose to lend that
Well, yes,
money
and they
out.
have to, and that's how banks operate. That's how they make
Okay, and
money.
that's what I was
Yes.
going to say. That's how they make more money because and that goes to a federal level because they if they lend that money out, then they're eligible for getting more money from the at the federal level to lend out even more.
From what I understand, though, and I could be very wrong on this. Again, I don't know much about the credit unions, but from what I understand, they don't borrow federally.
No,
Um,
no, no, no. And so let's say that it's not a federal it's not a credit union. That it's a smaller bank that does this. I'm pretty sure that they can get federal. And again, it goes back
Aaron,
to the
Aaron, you can help
shareholder.
us out with this. I don't know the answer to this. Do you know the answer to this?
Up to a certain point defined by the so that's what he's saying, and that's what I'm saying. Like if you lend out, you can lend out, and when you do lend out, and I think that's what Aaron's saying, when you do lend out, the Fed they will set limits on that, but they will also give you additional money for lending if you stay within those limits. I believe.
I don't.
Okay.
It's
Anyway,
not a mortgage, so
so
I don't know. I'm
there,
sorry. Yeah. I just it's not my specialty. So
Kevin, there you go. The answer is it is possible. Yes.
the question was, I think, at least from what I'm trying to answer, is does a credit union are they beholden to the same rules as a non-credit union when it comes to lending the money? So would they be a fractional banking entity? I don't know. I don't think so, but
Well, but
they
they're
have to make
federally
money.
insured, yeah, and they have to make money.
I don't know. I don't
Okay.
know. I do
We'll
know.
have an answer on that next week. Tune in.
Yeah, I do know that if you, how do I say this? I do know that the bond market is many, 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 many times bigger than the stock market, and
Oh
that
yeah,
most people don't know even what a bond is.
no, because nobody talks about it.
So, that's really what's at risk today is the bond market. I don't think anyone's really concerned about the stock market, and the two aren't related. The economy and the stock market are not related. And I know I just said that, and I'll say it again. The economy and the stock market are not related. Um, and neither are actions in the economy. I mean, the week that John F. Kennedy was killed, the stock market went up. You would just assume that if you're going to kill a sitting president, then we should sell some stocks. Maybe things are going
Yeah,
south, right? But no. There's plenty more examples of that too. So, I don't really know where I'm going with this. In fact,
I
I'm
don't
rambling
either.
at this point. Yeah.
I don't
Oh, I
either.
love this. Aaron helped us out. Thank you, Aaron. Can we put this up here?
Rules will be different. Federal FDC versus private lending. Private lending rules are off. Risk of yeah, and that's true. So it is if it is private money, they can do whatever the hell they want.
That's
I
basically what I
mean,
said. The trustees or the members that own it.
yeah,
Fine.
yeah, yeah. That's a
Thank
good
you,
point.
Aaron. Great. Appreciate it.
That's a good point. We need to
I
have
might be
Aaron
wrong,
on
but I'm
here.
going to go with it because that pretty much backed me up. So I think you're right. I think you're a smart man. Unless you're a girl, I don't know. Aaron could go both
And
ways.
you're handsome and
I'm sure you look great though. It's funny.
God, that sun just got out from behind the tree. Wow, bright right now.
You know what? We've been going for 34 minutes. I think it's a good time. We can
Yeah,
end
it's a
on a
good
high
time to
note.
shut this
It's
off.
great.
All right, guys. So this is what we do, and I will, and actually, I'm going to tell Stephen exactly what the question was, so that next week we can have a finite answer on this. But anyway, guys, we're going to be doing it again next Monday at 5 o'clock. We're going to be hanging around, drinking a beer, drinking some vodka, whatever it is. So if you are not driving, if you're sitting around, grab something, join us. Hopefully we make you laugh or educate you one or the other.
Yeah, and Aaron, can I say thank you to you for commenting?
Oh,
We're
yeah,
missing
dude.
comments on the show like crazy. We love answering questions. So,
Yeah.
thank you.
And when somebody's smarter than me, like Aaron, that's fine too. Like,
Yeah.
come on,
Heck
let's
yeah. I
go.
can't wait to get into an argument with somebody. That'd be awesome, wouldn't it? Oh,
It would be. Oh, that
put
would
him on
be
the
awesome.
show.
Yeah. Yeah. Let's do that. Let's do that. All right, guys. Next week, we are back after hours real estate. Have an awesome rest of your week. We'll talk to you soon.
Good night.